Welcome back to Financial Clarity for Doctors, everyone. This is Rachelle Vanderzanden here with Corey Janoff.
I'm here too.
Hello here. Today, we wanted to talk a little bit about the economy and how sometimes the economic data doesn't necessarily match how we're feeling about the economy and like that general sentiment of people. And it's really interesting because much, if not all data, but a lot of the data right now suggests that the economy is in a pretty stable position. Inflation has cooled a little bit, even if it's not necessarily down to where we would necessarily target. Unemployment numbers remain fairly low. New jobs are being added, even if they're not necessarily quickly being added. GDP is growing. The stock market has experienced some volatility early this year, but is still well within normal bounds of volatility and is also trading at all-time highs at this point, or very close to it. We're in middle of April right now. And so I think the big question is, why does it feel like the economy is not doing well when a lot of the data indicates that it is? So today we're going to dive into some sentiment things, like why are we feeling the way that we're feeling? Although that varies from person to person. Obviously, not everyone feels exactly the same. And also, like, what does the data look like? What are we looking at? What does the stock market look at? What is all of these traders looking at when they're determining, is the stock market a good investment right now? All the like that kind of stuff. So just to start, like I think some broad sentiment things are helpful to look at. Like where are we getting this idea that people are unhappy with the economy?
No thanks to the news, because
It's always doom and gloom,
yeah.
right?
But I mean, and surveys and polls, they're hard to trust because who answers survey and polls anymore?
People who have too much time on their hands,
Yeah.
maybe.
But anyways, University of Michigan, they've been doing a consumer sentiment survey for a long time, and currently, as of this recording in April of 2026. The US consumer sentiment is at its lowest level since 1978. So our view of the economy is in the pits. Many
Which
people
is
fear
kind of wild considering what we've lived through since 1978, like the housing crisis and the dot-com bubble and all of these things.
massive inflation. We've
Yeah.
seen stock market crashes. We've seen wars.
Yeah.
Um, anyways, yeah, lots happened. And we'll get to more of this, but people, I think, are far better off today than they were in the 70s. And depending on how old you are, maybe you want to go back to the 70s because those were your glory days. But but yeah, I think most people would take life in the 2020s over life in the 70s. And there's plenty of things that are driving down sentiment. Many people fear AI is going to create mass unemployment. We've seen some headlines mostly about big tech companies laying off people and citing AI as the reason. And in reality, it's because they just overhired massively during the pandemic, thinking they were going to grow. And then they were like, wait a second, we don't really need all these people. Um, so like a normal business, they're finding ways to deliver value to shareholders, and part of that is through cutting unnecessary costs. Um, you know, uh, People looking for jobs are having a hard time finding jobs, more specifically finding jobs at the pay level that they want. Especially if you were making high six figures at one of those tech companies and that job doesn't exist anymore. Well, good luck finding a similar one. I think only 1% of people make over $600,000 a year currently. So they're slim pickings. Not to mention geopolitical stuff. We're at war with Iran. We overthrew a Venezuelan leader. We're eyeing Cuba and Greenland. We're keeping a close eye on China. We're pissing off all of Europe and much of Canada and Mexico for that matter. So a lot of stuff. Not to go down that rabbit hole, but you can see where there might be some uncomfortableness or unhappiness with the state of affairs in America. The Fed chair transition is getting messy because I don't know what are they trying to do? Not arrest Jerome Powell, but like cite him for something, and that's holding up the transition of bringing the new guy in, Walsh, whatever his name is. Um, People still have it fresh in their mind how prices and interest rates pre-pandemic were a lot lower than they are today, despite inflation and interest rates returning to historically normal average levels. When things are up 25% from where they were 5 years ago, It's noticeable. Go talk to your grandparents about what prices were like when they were kids. I remember when I could get a hamburger at McDonald's for 35 cents. Yeah, that's inflation over 70 years. It gets more expensive. Housing affordability, that's a tough one. In a lot of markets, housing payments relative to incomes is above historical norms. Um, Not all families can.
Especially if you're trying to enter the housing market and you don't already own a
Bingo.
home. Like for
Yeah.
first-time home buyers, especially, that's a challenge.
If you already own your home, you're doing fantastic. You're sitting on massive amounts of home equity, which is huge, especially for all these retired boomers and other people who bought homes pre 2021. Like you've got a healthy amount of equity, which is a huge asset for most Americans. The majority of Americans, their largest asset is their house. So having that price appreciation, if you owned a home prior to the last few years, that's really benefited you. But yeah, if you're a young family trying to move into a house, it's getting more challenging. Um, but if you look at home ownership rates, for Gen Zers compared to millennials, Gen X, boomers at the same time, it's not too far off. So yeah, you could say, oh, only whatever percentage of Gen Zers own homes. Well, a similar percentage of boomers in their 20s owned homes, and millennials and Gen Xers. So it's not, that's how it's supposed to go. When you're young, it's tough to afford a home. And then as you get older, more of your peers own homes and you eventually own a home. Not everyone, right now our home ownership rate in America is about 65%. Down from a peak of 69% in the early 2000s, but it's never been higher than that. So we're, I would say pretty healthy historically from a home ownership standpoint. Um, but still, it doesn't make it easier from a sentiment standpoint when you see prices and if you want to move and interest rates have gone up compared to the 3% rates they were a few years ago. So it makes housing payments more expensive. Yeah, we talked about the geopolitical stuff, but literally everything has been politicized these days. Like even sports and music are starting to be politicized, which is super annoying. Hopefully they don't go after food next. Well, they sort of are, Maha diet. Um, but it's literally everything. If your team is in office, you have a more positive view of the economy. If your team's not in office, you have a more pessimistic view. Statistically, the economy has been the same under both Biden and Trump. Companies have record profits. Stock market is hitting an all-time highs. Unemployment's low. We had a brief bit of inflation with the government stimulus during the pandemic, which overlapped both presidencies, I might add. But Democrats had a more favorable view of the economy during the Biden years. Republicans have a more favorable view of the economy during the Trump years. It's always been that way. If your team's in office, you think things are going better than when your team's not in office. If you don't have a team, maybe you can be somewhat unbiased, but it's hard to remain unbiased with anything. And I mean, for example, the president could say, hey, we're going to give tax breaks to the wealthy to help grow the economy. And half the country is going to celebrate. The other half will yell, that's going to kill the economy. And then the next president could say, we're going to raise taxes on the wealthy to help grow the economy. And half the country will celebrate. And the other half will yell, that's going to kill the economy. So people have opinions. Data doesn't always support those opinions. And that's okay. You're allowed to have your own thoughts and opinions. But today we're trying to remove our biases and feelings from the equation. As financial planners, there is a fine line between like the science and math behind financial planning and the art and the feelings of financial planning, because, people want different things. People have different goals and objectives, and it's finding a way to achieve those as efficiently as possible. But the math doesn't change. Like math is math, regardless of what your feelings are. So we still have to save a little bit for retirement if we want to retire one day. Still gotta live within our means if we want to be able to, afford life and go on vacations and help pay for our kids to go to college and whatnot. But anyways, let's look at some data now that we've talked about some sentiments and feelings, Rachelle.
Yeah. Yeah. So we'll talk about like some statistics and numbers and the economy. And Like, obviously, even though we can look at this in a quantitative way, it's not like this data is foolproof either. Like, so we can talk about like math doesn't lie, blah, 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 blah. But realistically, some of these things are not necessarily like set in stone and they could be revised like 2 months later. So we look at like unemployment numbers and it's like, this is the number you have right now. And then 2 days later, like 2 months later, maybe it's different, So not all of these things are really easy to measure, but they do give us some indication of like where we at, even if it might not be exactly right. The other
I
thing
would
is
add
that,
it's
yeah,
also not difficult to find data to support
that's,
your
yeah, like
hypothesis,
just cherry
support.
pick your data.
Yeah.
Uh-huh. Yeah.
And, it's with anything, like I love statistics. Sports is full of stats, and it's easy to make arguments for players and throw out statistics. Oh, this guy is great at
Hmm.
this stat. Look how many points, assists, rebounds. Look at his on base percentage. Look at his QBR. Look at his passer rating under pressure, blah, blah, blah. But like you can find data to either support or contradict whatever argument you're trying to make. So,
Yep.
um, obviously, we've cherry picked some data for you for this episode, and you could probably
I know.
find
Yeah,
data
Corey's like,
to
we
go
try to be
against it.
unbiased. Everyone has a bias. We have biases too. Like
Yeah.
it just is part of life. But when we're looking at the numbers, even when you're like looking at the economic numbers and you have a bias, it's not like it's going to 100% say the economy is good, the economy is bad. There's always going to be like some sort of mixed bag of indicators. But right now, overall, the economy does look fairly stable when you're looking at the indicators. Like there's some little signs of softening and stuff like that, but generally speaking, like we're not looking at awful numbers right now. So one number that people look like at a lot when we're assessing the economy is just unemployment as a total. So right now, unemployment is at about like 4.3%, which is pretty historically low, but slightly higher than it was a couple years ago. So it's kind of crept up a tiny, tiny bit. Like the unemployment numbers have changed a little bit. There's not a lot of hiring out there, but there's also not a lot of firing. So it's companies kind of holding on to their best employees as people kind of matriculate and leave on their own. Those people may have a hard time finding another job. So, like if they're retiring, it's not an issue. But if you're leaving your job voluntarily and going out to try to find another job, it can be potentially challenging to do. Or if you're in part one of those sectors where there have been some layoffs, especially like tech and things like that, it may be, again, challenging to find another job. But all in all, like that unemployment number, that's really normal. Like 4.3% is not like a super high unemployment number. It's well within kind of normal bounds and doesn't necessarily indicate that the economy is struggling. It's
I would
not
say it's
like if we're
probably low by historical
exactly like so if
standards.
we're
Like, this
yeah,
is a
so if
good
we're looking
economy
at
if it's
that,
4% unemployment.
yeah. So if we're looking at that like at face value says, okay, we're doing okay. There are some weak job addition numbers, like added jobs to the job numbers in total. Some of that can be attributed to immigration basically halting. So we don't have as many workers necessarily, and so there's fewer jobs that are going to those workers because they don't exist. They're not here. There's more people who are maybe boomers retiring. I don't, are we supposed to say boomers? I don't know.
Maybe not
Uh,
politically correct. More
Whoops.
seniors, more
Baby
people,
booming. I
more
mean,
people
there's a baby
exiting the
boomer
workforce.
generation.
Yeah. More people are exiting the workforce than entering the workforce just due to
Yeah.
we have an aging demographic. More people are retiring than there are young people coming in to fill their shoes, which
Yep.
is going to impact the job growth numbers.
Yep. The labor force participation rate is at 62% for people who are working age, which is measured from the age of like 16 to 64. So that's down a little bit. That's down from a peak of 67% in the early 2000s. It could be that less people feel the need to work, which is maybe kind of positive. Like we don't need as many people to work to be paying the bills and everything at home. A lot of that is driven, or at least some of it is driven by some sharper declines concentrated in like younger age groups, especially like that age 16 to 19. So that's also an indicator potentially that like parents are able to support those kids a little bit longer while they're in school and they're not getting those after school jobs. There's not as big of declines for people who are in that age group and are not in school. So if you're not in school, you are probably working if you're in that age group.
Well, and unemployment for younger people without college degree or even with college degrees, like if you're 20s or younger, like I think the unemployment rate is around 10%, but that's like historically what it's been. It's tougher for
Yeah.
younger people to get jobs. That's, you don't have any experience. You don't really have great skills to offer. Um, so that, that's normal. It's not,
Yeah.
we're not doom and gloom yet.
Well, and maybe that's a good point in terms of sentiment because I think there's like this assumption now, which has kind of evolved over time, that you go to school and you get a college degree. And if you come out of college and you have a college degree, you can go get a job. But I think like even people with college degrees are struggling because there's so many more people with college degrees. Like, more and more people have gone to college over the last few decades. And then now they're coming out and it's still really challenging to find a job. And a lot of those folks are underemployed too. Maybe they have a 4-year degree, but they're waiting tables. That's
Yeah.
not what they paid for 4 years of school to do. So they're not unemployed, but they are definitely underemployed. And I think there's
Yeah.
definitely some sentiment in that generation that's happening. That's
And
that's very much related to that.
and you and I lived through that. I mean, you're I think a couple years ahead of me, but like I
Yeah.
graduated in 2009. The
Hmm.
economy was the worst economy we've had since the Great Depression, and jobs weren't available. It was either commission only sales jobs or yeah, maybe go wait tables at a restaurant, but even restaurants like they were empty. People weren't going out to eat
Yeah.
because unemployment was higher. Um, and it was a lot tougher for younger people without experience to land jobs. And even people that had experience that were higher paid, companies were like, "Hey, we got to trim some fat. We can't pay your big salary. Let's go with someone who doesn't command as much income." So
Yeah.
it was tough. But yeah, it is true. You could blame AI, you could blame whatever, but entry level jobs they're tougher to get for people coming
Hmm.
straight out of college. That's why people go to law school. We have too many lawyers. No offense if there's any
Hmm.
lawyers listening.
I almost
Um,
did that.
yeah,
And then I was like, wait.
yeah.
But
But
yeah.
yeah, it's it's always been somewhat challenging for younger people to get jobs. I think,
Yeah.
that's just always how it's been.
Yeah. There's some interesting data too related to worker productivity. It looks like potentially it's increasing, like some pretty small increases. We're looking at like a 2% year over year increase over the last few years versus maybe 1.5% increase in productivity year over year pre-pandemic. So that's kind of interesting to see what's happening and how that trend will evolve over time. But workers are potentially becoming more efficient and getting more done. Um,
And this is where
we
you
already
can skew
talked.
some numbers. It's like, oh, 1.5
Yeah.
versus 2%. That's a 0.5% difference. Big whoop. Well, a 0.5% over 1.5, that's a 33% increase in productivity gains year over year.
Yeah.
So again, skew the numbers how you want.
Hmm.
But workers, at least as of late, it seems that they're getting more productive. Again, could say AI, could say, hey, we got to actually work to keep our jobs because the economy's tighter, versus just not work as hard because everyone has jobs. But whatever the reason is, seems like people are becoming more efficient, able to get more done.
Yeah. Yeah. We know the S&P 500 is trading at all-time highs as of this recording, which is April 15th, tax day. Woo woo. More people are participating in the stock market, and I think that that's partially just because it's become a lot more accessible for retail investors through platforms like, Robinhood and like e-money and like all that kind of stuff. Like there's just different ways that people can work on investing and be able to engage in that. So 62% of people own stocks now, which is up from 52% in 2016. So over the last 10 years, that's increased by about 10%. 54% of people with incomes between 30,000 and 80,000 have money invested in a non 401k IRA investment account. So like just an investment account, which I would argue is maybe not the best use of money for a lot of people, but whatever.
But
We don't know their
yeah,
personal
but
situations.
you could argue like, hey, that's fantastic. You have extra money that you can invest and you're participating in the stock market. And
Hmm.
I mean, I like that next bullet point. Since
Yeah.
2020, the value of equity is held by the bottom 50% of households, which is that 30 to 80K income
Hmm.
mark.
Hmm.
The value in aggregate of their stocks that they own has increased 2.5x, 200 billion to over 500 billion. Um, like that's amazing. how
Yeah.
more people are participating, more people are seeing their net worth grow due to their participation in the stock market.
Yep. I like
And
the next one too. So sounds like JP Morgan Chase did a report that found that 37% of 25-year-olds used investment accounts in 2024, which is up from 6% in 2015. And that is very much, I think, driven by the use of apps and just making it a lot more accessible for younger people in a way that like that technology is comfortable for them. They're used to it. It's not like you have to go to a person like me or Corey to potentially put a little bit of money in the stock market. You can download the Robinhood app. Like there's just so many different ways that you can approach that, especially if you're not investing very much. If you're just like trying to get used to the stock market and just dabble a little bit or whatever it is.
yeah, no minimums, no barriers to entry. Like if you have $1, you can start investing. Which I think is a fantastic evolution from where it was 50 years ago, where you had to have a
Mm-hmm.
minimum amount. You had to call a stock broker. You had to buy at least 100 shares of that stock. So it was probably costing you $10,000 plus to make that purchase. So,
Yep.
and a little bit going back to that S&P 500 hitting an all-time high as of this recording. I know this will become stale the moment we stop recording, and by the time you hear this, probably in 2 to 4 weeks, like whatever. But like over the last couple weeks, like I've had not a lot, but a few conversations with people about like, oh, how do we prepare for the stock market declining? Things are turning south, blah, blah, blah. It's like,
When it
they're
crashes. Not
not.
like if it crashes, when it
Well,
crashes.
we're saying, hey, the stock market's been going down. What should we do to, reposition our portfolios to plan on it continuing to go down? It's like, hey, it did go down a little bit. I think at the biggest drawdown, the S&P was down 6%, but we're at all-time highs now. Like, so whatever news you were watching about the stock market going down, like that was yesterday's news. Um, Tomorrow's news could be different. It could be down again by the time you hear this. But as of today, US stocks all-time high. So that again, the data, and that one's not a data point you can argue. Anyone can look at what's the S&P 500
That's so
valued
true.
at.
Yeah.
There's no subjectivity here. This is
But
what it
tomorrow
is.
it could be different. Like, I
Tomorrow
guess
it could be
that's
different. We could see a 10% decline tomorrow for all we know.
yeah,
But at least
for
as of
sure.
this recording, stock market is at an all-time high,
Yep.
um, despite all the craziness around us.
I actually had a conversation with a potential client who probably will not be a good fit, who was basically like, how do I move approximately 10% of my net worth into physical gold? Gold ETFs do not do it for me. How do I get 10% of my net worth in physical gold? And I
Costco
was like,
sells gold
oh,
coins.
I know, but I was like, oh no. What are you reading? But anyway, okay. Other than the stock market and our fear of this big impending doom, inflation has definitely been a sticky like topic for people. Like that is something people are very, very focused on, especially because, like Corey was saying earlier, we're kind of fixated on what prices were 3 years ago, and we're not going to go back. There's not going to necessarily, well, I guess you never can say never, but like it's unlikely that we will experience some very significant deflation where prices actually decline. Like this is where we're at right now.
Except
And
consumer
inflation,
electronics. TVs are the only
yeah,
things that get
yeah.
less expensive over time.
Well, not really, because then you just buy a fancier TV that costs more, right?
Well,
Like that's what actually ends up happening.
you get the 70-inch TV for the same price that you got a 55-inch 10 years ago. Um,
Unless you like want, trust me, Nick works
oh yeah,
for,
you can get some high-end
you can
OLED.
you can
Yeah,
spend a lot on a
you
TV.
can spend a lot on TVs, but I love like
Yeah.
when we bought our house in Wilsonville, I bought what I thought was a nice TV at the time. It was a 55-inch Samsung 4K, whatever, for like $1,000 on sale, down from 1,200. And a few years ago, I was in Costco. Same TV was selling for $400, not on
Yep.
sale. And I
Yep.
just bought, this was a year ago after my kids broke another TV because they throw stuff in our house. A 65-inch LG 4K HD,
Blah
etc.,
blah blah blah
for
blah
like
blah blah.
700 something dollars.
Yeah.
So it's not a fancy one, but it's fancier than anything we had growing up.
Oh
Like,
my God. Like so much fancier. Like that's ridiculous to compare it to when we were growing up. It makes me feel old.
And it
But
was less expensive than any TV we had growing up, probably.
but anyway, in general,
In
inflation is
general. Yeah.
sticky, like you know. So it's been about 3% this year to date. In March, it was actually up 3.3%. So it was a little bit higher than it had been the last few months or whatever. That was largely driven by increases in energy costs, so like oil and gas, especially because of the conflict in Iran. So that's a big part of it. But like core CPI, like the when you take out food and energy, was actually much lower and looked pretty good, honestly. So I think, there's good and bad things that we're looking at with inflation. Part of it, I think, is also that we got used to those really low inflation numbers of like 2%, 1.5% during COVID and things like that, early in COVID, before kind
Or
of the
like the
stimulus money.
2010s where it was below 2%
Yeah.
for like 12 years.
Yeah, exactly. So if we're talking about like how does this feel in terms of differences, if we're looking at 2% versus 3%, well, that's, a 50% increase in what we expect inflation to look like, right? So that it makes sense that we can kind of experience this in a different way from how like we read it on paper. Like realistically, a 3% inflation rate, while it's not like great, it's not bad. It's not That's not awful.
That's
Like
the
that is
historical average.
historically that's the historical average. Exactly. So when we look at these things, it's like it's hard to like put things into perspective when you're pretty blinded by like your recency bias. Like what happened recently? What do I want to be happening moving forward based on my expectations of what that will look like?
On
Yeah.
the positive
And
note,
then
wages have
yeah.
grown faster than inflation. Not a ton, but
Yeah.
despite prices being higher in aggregate, you guys have gotten paid more, so you can afford those higher prices. And everyone else in America in aggregate has seen their wages go up, so they can still afford those higher prices. Doesn't mean we can't complain about higher prices, because if there's one thing we like to do as humans, it's complain. And yeah, it's things are more expensive. Like, getting baseball cleats for your kids, going on vacations, healthcare, school, housing, like
Hmm.
you could go down the list, except TVs. Um, so, but anyways, so let's dive into some demographic stuff here. There was an article in the Wall Street Journal and a number of other publications citing some research that was published um, about the growing upper middle class, which is defined as households earning 130,000 to 400,000 per year. Um, and only about 2% of households earn above 400,000 per year, and these are as of 2024 numbers. So I guess shift up a little bit for 2026 numbers. But
Hmm.
anyways, as of 2024, 31% of households fell into the upper middle class category, which is up from 10% in 1979. So yeah, why 1979? I don't know. That's just when they went back all the way to look at data. So we've seen a growing number of people in the upper middle class category. Low income households, defined as families earning less than 40,000 a year in 2024 dollars, has dropped from 30% in 1979 to 19% today. So this is huge. The number of people living in poverty has almost been cut in half in the last 45 years. And you may not notice much change from one year to the next, call it a fraction of a percent every single year, but compound that over 50 years, it's going to make a big difference. Yes, we've seen the same things with like life expectancies, deaths by certain diseases, uh, cancer, heart disease, et cetera, infant mortality, like you name it, you go back 50, 100 years ago, all those things are a lot worse than they are today. They may not have felt, better because one year over the next, it's a minuscule improvement, but compound that over a long period of time and it adds up to be a significant difference. So based on this math, we got 31% upper middle class, 2% in the rich category, 19% poor. We can conclude that 48% of households are in either middle or lower middle class. And so we got, from that standpoint, a pretty healthy, robust economy. More people have moved up the wealth ladder than down. But middle and lower middle class, it's challenging. Like you don't have a lot of flexibility with your budget. You can afford the necessities, food, housing, um, clothes, but you're not flying first class to Europe. You're not going to
You're maybe not
Hawaii.
going to Europe at all.
You're not going to Europe at all.
Yeah.
You're not buying a Rivian or a Mercedes. Like you're driving a
It may be
used
challenging to
Ford.
buy a house depending on where you're at in there and like where you live. Like geographically that can change a lot too. But
Yeah, you might be shopping for some clothes at Goodwill or getting sports gear at Play Against Sports, but at least you can still get by.
yeah.
Um, and you feel like you should be able to afford more things because everyone around you, and especially with social media and the internet and Instagram and whatnot, it seems like they all have this cool stuff. Why don't I have this cool stuff? Especially with housing. But it's the middle class, at least statistically speaking, is shrinking upwards, not downwards, which is I think a positive from an overall well-being standpoint. Now, despite being in the upper middle class, many people in that category, still feel like they're middle or lower middle just because that rat race of life. Housing is more expensive, school is more expensive, healthcare is more expensive, kids' activities. Like I saw some story, it's estimated that families spend over $1,000 per year on their child's primary sport in 2024. So the enrollment fees, the equipment, the gear, travel, etc. And that's just the primary sport per
Yeah.
kid. If you have two or
Yeah.
three kids and they play multiple sports, like you're spending a lot of money on your kids every year.
We have a
Like
family member who, like Nick's 14-year-old niece, she plays competitive volleyball, which is wild. They paid more than she's 14. She's 14 and she's great. And she's like, it's so fun to watch them play. But it's not like there's enough people right where they live to be able to like competitive sports locally. They have to travel in order to be competitive because they need to find more teams that are kind of playing at the level that they're playing at. They paid more than $30,000 last year for her to be competitive, like for her to travel with her team. And they basically do it year round because she's like playing volleyball with her team. And then in the summer, she's playing beach volleyball. And it's wild. Like,
crazy. Good for
but
her.
in order to be competitive at that level, they have to do it. Like, and she's really dedicated to it. So they're just supporting her and trying to make it happen.
Yeah. I mean, I
Yeah.
see like around here, um, there's third graders on the travel soccer teams and travel lacrosse teams. And at
Can
least
you
in
imagine
Central
people doing
Oregon,
that in the 1970s and 1980s?
they
Like,
didn't
no,
like
just
AAU
no.
basketball didn't exist.
Right.
But they like you have to like at least important like when I played travel soccer, we traveled around the Portland area and we maybe like did a tournament in Salem or Medford or
Right.
Bend, which is all
Like
right, you
two times
gotta
a year.
yeah, it was like a couple times a year. Sure, you gotta stay in a hotel room 1 or 2 nights. But you drove by car. You weren't flying anywhere. But like here, you're traveling every weekend because unless you're playing another local team, like you gotta go to around Oregon, Washington, California, et cetera, to go play other
Yeah.
teams.
Yeah.
Um,
They're going
and
to like Phoenix, Reno,
I believe it.
Indianapolis on top of like doing the like kind of geographically local stuff. But that even is like, been to Portland, been to Spokane. Like that's the local stuff.
Yeah,
Like,
it's a plane
it's
flight or
wild.
a 3 to 6 hour car ride.
Yeah.
Um, and sure, like in absolute terms, people are way better off today than they were 50 years ago, 100 years ago. But in relative terms, we're still trying to keep up with the Joneses, only now there's more Joneses to keep up with. So it's even more competitive from a relative well-being standpoint. But objectively, like today, even, the lower middle class people in America live better than kings lived in the 1500s, 1600s. Like you have a mattress to sleep on, you have Advil, you have penicillin, you have sunscreen. Like that didn't exist 100 years ago. Um, but more people have that stuff. So the luxuries become necessities over time. And, if more people have nicer things than you might start feeling a little left behind.
Hmm. Yeah, we have like a brief little part about AI, and I think some sentiment is that AI is taking jobs from people or will take jobs from people, which is maybe a little bit more relevant. It's statistically, again, about 50% of workers now use AI in some capacity to help them do their jobs, and about two-thirds are seeing a positive productivity impact Like, okay, like we are using this, it is helping us be more productive. Maybe like that slight increase in efficiency is partially driven by AI. Who the heck knows? Goldman Sachs estimated that there's about 16 net jobs per month that are lost to AI. Some are being created. So about 9,000 jobs that are being created per month, about 25,000 that are being lost. So that's not a ton. Out of a working age population of about 200 million people, that's 1 in 1,000 working age person people that are like maybe losing a job per year to AI. It's not exactly driving unemployment at the current pace. And again, that could change as we start to see AI evolve and being able to do different things that people do for work, maybe in medicine, maybe not in medicine. I do have some clients that I know are concerned about those long-term impacts more necessarily than like the short-term impacts.
Yeah.
Yep.
Um, Anecdotal evidence, which is fun because that's what the news thrives on. Hey, let's
Yeah.
find
And
a
honestly,
story about someone suffering and make it a big
yeah.
deal and extrapolate it to sound like everyone is feeling this pain.
And that's also what we base our personal opinions on, right? It's like all the anecdotal evidence around us more than what we're reading in the news and things like that. It's like, what is our friend group experiencing? That kind of stuff. So, one thing that's happening locally where I live is that our local school district is experiencing like a huge budget shortfall, which is literally leading them to cutting classroom teachers, cutting support staff, like doing some pretty drastic things. And it feels like a sign of a bad economy. Like it does, but it's not really about that. It's mostly related to demographics. Like the population in the public schools is declining. And because of that, they're having to do these big budget cuts. And it's really interesting because a lot of the budget cuts that they're doing and some of the staffing change that they're doing is actually kind of dialing it back to what it was 15, 20 years ago. So it's not like the reason it feels so hard is because we've become used to this certain level of staffing in our schools and it feels necessary, but we're dialing it back to what it was 15 to 20 years ago when it probably felt okay. Like maybe it was a little bit challenging in some ways. But again, that it feels like that's a bad indicator for like what's happening in the overall world when realistically it's not. It doesn't have anything to do with that.
There's more to
I think
do with like tax dollars and where we voted to allocate them because there was an influx of cash during the pandemic, which schools hired more support staff, more teachers, et cetera, and then that's dried up and that hasn't been replaced. So now we got to cut,
this isn't
and it
even that though.
sucks. Yeah.
Yeah, this isn't even that. This is literally like we have fewer students, so we get less money from the
There we
state.
go.
Like it's
Oh yeah, that
literally
makes
like
sense.
student population is declining. We didn't necessarily project for that at the school district level, and it's really and I don't know if that's partially like people can't afford to buy houses and like young families aren't necessarily buying houses in these neighborhoods. Like they're just a little farther out and like farther out school districts from the
Yeah.
center, from like the urban center. But yeah, it's really interesting. I
Yeah,
think we
we've
also,
seen like
yeah,
again, anecdotally, our school sent
yeah,
out an email like, "Hey, we've, interviewed some teachers, but we're having a tough time because
filling
of the
positions.
housing affordability. Yes, they say they'd love to come teach here, but if anyone has any ideas or maybe has a rental that you'd be willing to rent to one of the teachers, so I think that can be a challenge because as we all know, teachers are not paid enough in this country. Um, and then tack on top of that, being able to afford housing in the areas that the schools are and whatnot. So,
Yep.
um,
I think anecdotally, everyone also has a story of that friend or friend of a friend who was laid off or lost their job for whatever reason, and it took a really long time to find a new job that was adequate. And so there's some evidence that long-term unemployment is increasing. So that 4.3% of people that are unemployed, it's like what percentage of those people have been unemployed for 6, 12 months longer? Like that's obviously makes people feel the impact much more strongly when they've been out of work for that long. And I definitely know of some people that experience that personally or like friend to friend again. And so I think when you hear about those kinds of stories, like that feels scary. That feels like, oh, what would happen if I lost my job? Would I have that same kind of experience?
yeah, no, definitely have a couple people in that boat, where it's
Hmm.
tough finding a similar paying job in a similar field to what they used to be in.
Yep.
Um, On the other end, there's some areas and industries where they can't fill roles because there's just not enough employees out there. Like we got an email from our dentist the other day apologizing for scheduling hiccups. This is like a mass email. It wasn't to me individually, but they're basically like, hey, we're having a tough time hiring and keeping dental hygienists. There's just not enough of them out there. So sorry, we've had to cancel some appointments because we don't have hygienists. CPAs, like we've seen this trying to help our clients find tax professionals to work with over the last several years. I've struck out finding, then again, I haven't done like deep dive searching, but like most CPAs I talk to aren't accepting new clients, or maybe they are, but it's only really specific circumstances that are maybe above what
And they're
are.
charging a lot because
Yeah,
they can,
exactly.
like they're busy.
It's like we'll accept you if you have a complex situation or a small business that you run and our minimum's 2,500 a year. It's like, well, what about just like a W-2 job that doesn't want to take the time to do their taxes? And that seems like a lot of money to pay you to just upload their
Hmm.
W-2s into a form. Um, Now, the nice thing about the free market is when there's demand, it gets filled. We've seen an increase in, or data would support that there's an increase in accounting majors and people taking the CPA exam. Although a lot of accounting majors try to go into audit rather than tax because there's more money in that. Makes sense, but again, market more demand than supply. It's going to increase the price that tax accountants can charge, um, and you look at demographics of CPAs. There's a lot more CPAs with gray hair than younger CPAs. So they're anticipating, a lot of CPAs retiring and needing to fill those shoes. So wouldn't be surprised if we see more young accountants coming in, and then with the adoption of AI, that can help process more tax returns than you used to be able to do when you
Yeah.
had to do them by hand with an abacus. Um,
Yep.
Gasoline. This is a fun one because gas is very inelastic. So if you took economics, there's elastic pricing, which means if the price changes a little bit, the demand dries up or increases significantly. Inelastic is it basically doesn't matter what the price is, people are going to pay it. The demand's not going to change much. Gasoline is that. Like gasoline goes up, gasoline goes down. People are still buying the same amount of gas.
You got to
Same
go
with
to
like
work. You got to
toilet
do
paper.
whatever.
Like if you cut the price of toilet paper in half, it's not like people are going to the bathroom twice as much. Like they're only going to use so much toilet paper. Um, you double the price of toilet paper, people still got to buy it. I guess maybe more people will buy bidets instead. But
Ew,
anyways,
gross. Okay, anyway,
moving off of
moving
this.
on.
So gasoline, it was below $3 a gallon a couple months ago. Now it's like $4 to $5 a gallon, depending on where you're at.
Five
Maybe
plus
more if you're
here.
in
Yeah.
California. Yeah.
Yeah.
I haven't heard of anyone yet ditching their car in favor of biking to work. Nobody I know is changing their summer vacation plans due to increased airline ticket prices. I mean, anyone making thinking twice about making online purchases because prices and shipping costs have increased? Like, hasn't
Not
happened.
necessarily. I mean, you use Amazon, and Amazon is like, free shipping on whatever you
Yeah,
want,
but the price
basically.
they
It's really
might.
baked into the price
Yeah,
of the goods, probably.
exactly.
Yeah, I do think realistically, like most of us are fairly privileged, like you and I, everyone listening to this podcast, etc. And we're not going to make a lot of changes based on gas prices or like some inflationary changes. We're probably going to do most things the same. But I do think that some of these lingering effects of like high inflation affect lower income earners a lot more. And they are the people that may be changing their vacation plans or deferring a vacation and things like that. Like they're probably still driving. They've got to drive to work. They got to go to soccer practice, whatever. But some of the bigger expenditures may take a back seat, like we can't go to Hawaii this year. Like that's just not happening.
And this is where
So, and
that
I, yeah,
K-shaped economy that you've heard about kind
exactly.
of
Yep.
where the wealthy are driving the economy because they're spending all the
Yep.
money. And there is some data to support that. There's also some data to contradict that of like,
Yep.
hey, the necessities, people are still buying them. And the lower half of the population is still chugging along, paying for the things they need. The people that spend money on the luxury vacations that go to Hawaii, that go to Europe, that's the top 10%. The Disneyland crowd, like, and yeah, they're still doing that. That's not changing either. So sure, they're driving the spending on the higher end of the spectrum, which is driving the profits for the majority of the companies out there delivering those goods and services. But that's like, what is it? Is it the Pareto principle, the 80-20 rule? 20% of the revenue is driven, or 80% of the revenue is driven by 20% of the customers. You look across pretty much any business, retail, healthcare, you name it, like there's a smaller percentage of people that drive the majority of the revenue, and it's pretty much always been that way.
Mm-hmm.
Um,
Yeah.
so I don't know, like what are you gonna do about it? I don't think that's a negative. That's just it is what it is.
Yeah. Who knows? I think everyone has different perspectives on things like that. I think that's when you get into politics a little bit. But I mean, long story short, like, what does this mean for all of you who are listening? Let's try to bring it back a little bit and make it somewhat relevant. I think maybe stop watching the news. Corey and I had a whole discussion about this ahead of time. Like, should you watch the news? Should you not watch the news? Like, no, like, probably don't watch the news. They make everything crazy and like, like the big stuff sells, right? Like it's not like the little stories that sell, it's the really dramatic things. So they're going to like really focus on those things that are pretty negative generally. There's not a lot of hyping up the good stuff. If you need to be informed, which realistically I think that you need to be informed at least to a certain extent. Corey disagrees a little bit, but you can
I
read
think being
news.
informed is good. How
Yes, being
much
informed is good.
information you need is
Yes.
debatable.
How much? Yes. How much should we be informed? But I think reading is a much better solution because you can, I don't know, I guess filter out some of the like just really overdone stuff. But even when you're reading, honestly, you can still get a lot of that. But, pick your news sources and try to find things that are as unbiased as possible. It's common for people to have a really pessimistic view of the overall economy. That's somewhat normal, but an optimist but also having like an optimistic view of your own personal financial situation. Like I think the economy is bad. I'm doing okay. So, I mean, really, that's what you focus on. Are you doing okay? Because that's what matters for you. And if you're concerned about other sectors of the economy or like how other people are doing, you can increase your giving if you're doing well, like, and you feel like you want to do something about it, like maybe increase your charitable donations if you feel like you're in a good spot to do that. I think this is a big one, but in general, doctors and healthcare professionals have a lot more job security than other industries. And maybe that's not true across every single specialty, but for a lot of specialties, and especially for generalists, like people are still going to get sick. People still need to go to the doctor. Like you're not likely to experience the same level of job instability that other people would, even if unemployment starts to like increase. Like it's unlikely that that would affect a lot of you very much.
Yeah, maybe some elective specialties, people might opt not to pursue
Yeah.
those if their budget's a little tighter.
Yep.
Um,
Dermatology, plastic surgery,
yeah, but I mean, if anything, health issues might increase if the economy's struggling.
hmm
But let's see what else. What can we do? I think the usual: have an adequate emergency reserve, live within your means, save for retirement, etc. All the
Yep.
things, the fundamentals. Focus on what you can control, and more specifically, the things that matter, which you can control. So, like what expenses you elect to take on, what type of house you live in. Maybe don't sell your house and move unless you need to. But like if you're looking
hmm
for a new home, all right, let's be reasonable. What's realistic? What can we afford to still allow us
Yep.
to achieve our other goals that are important to us? Align your spending with your values. So like having almost like a mission statement of how you want to live your life. I know, we've referenced Carl Richards before. He's been on the podcast, which was a cool episode from a handful of years ago. Um, but his mission statement is spending time mainly outdoors with my family and people I care about and serving in my community. So if you can kind of reverse solve your life around if that's what's important to you, all right, how can I work my life to spend time outdoors and do outdoor activities? How can I work my life around spending more time with my family and serving in my community? If that's what's important to you, great, do that. If you find yourself spending money and time is an asset, a resource,
hmm
and it's not on those things. Like, well, maybe let's reevaluate how we're doing this. Like, if you're spending a lot of time and money on something that's not bringing you joy and it's not important to you, well, let's stop. And if we have time and money and resources we can spend on things that bring us more joy, well, let's maybe focus on that and um, you know, focus on that today and also save so you can continue to do that tomorrow and
Yep.
forever into the future.
Yeah. Obviously, the economy matters, but really what matters more is your personal situation and focus on that more than anything else.
There we go. Well, thanks for listening. We'll see you next time.